Investment decisions are some of the most important choices a business leader can make, involving significant commitments of capital today while looking ahead to uncertain future returns. Whether a company is expanding production, entering new markets, launching new products, upgrading technology, or acquiring other firms, making the right investment choices is essential to protect shareholder value and support long-term success. Investment appraisal, or capital budgeting, is the process companies use to carefully evaluate potential projects to see if they make financial sense and fit with the company's goals. Because money is limited and investments often cannot be undone easily, it's important to use solid analytical methods to estimate profitability, assess risks, and ensure strategic alignment. In this overview, we'll look at key techniques like net present value, internal rate of return, payback period, and others, showing how they work, their strengths and weaknesses, and how businesses use them to make smarter investment decisions. The image of the clock beside stacks of growing coins highlights the critical connection between time and money in these decisions, emphasizing the importance of timely investment choices for maximizing value. Investment appraisal techniques play a crucial role in helping businesses make better decisions by ensuring capital is used efficiently, especially when resources are limited but multiple projects compete for funding. These methods rank projects to focus investment on those expected to create the most value. They also account for risk and the time value of money, so future cash flows are properly assessed in today's terms using approaches like NPV, IRR, and discounted payback. Beyond immediate financial analysis, investment appraisal supports broader strategic goals such as growth, diversification, sustainability, and technological progress. It also improves accountability by promoting transparency and reducing bias, as decisions are based on clear, evidence-backed evaluations. Finally, comparing actual outcomes against appraised projections helps refine future budgeting and investment decisions, continually enhancing the accuracy and effectiveness of capital allocation. Modern capital budgeting combines both discounted cash flow methods and non-discounted techniques, each with their own benefits and drawbacks, so they work best when used together. The net present value, or NPV, is a key approach that measures how much shareholder wealth increases from an investment by comparing the present value of anticipated future cash inflows to the initial cost. You calculate NPV by summing the expected cash inflows for each time period, discounted back to today using a rate that usually reflects the company's cost of capital, then subtracting the initial investment. The basic rule is to accept projects with a positive NPV and reject those with a negative one. In practice, companies rely on NPV for major decisions like capital projects, mergers, and infrastructure investments, as it forms the foundation for many valuation models. For example, a manufacturing firm considering automated machinery will discount future savings and revenue at its weighted average cost of capital to see if the investment will surpass required returns. If the result is positive, it shows value creation. The major advantage of NPV is that it directly measures how much value an investment adds while properly accounting for the time value of money. This approach aligns well with the goal of maximizing shareholder wealth, but it does have some downsides. For one, it requires estimating the discount rate, which can be tricky. It's also sensitive to the assumptions made during forecasting, so small changes can significantly affect outcomes. Additionally, it might be less intuitive for decision makers who don't have a financial background. Moving on to the internal rate of return, or IRR, this is the discount rate that makes the net present value of an investment zero, essentially showing the expected rate of return on a project. The decision rule here is straightforward: if the IRR is higher than the required rate of return, you accept the project; if it's lower, you reject it. One reason IRR is popular is because it's expressed as a percentage, making it easier to compare against hurdle rates or alternative investments. For example, an energy company might focus on renewable projects with IRRs above their internal hurdle rate that accounts for the risk involved. The key advantages of IRR are that it's easy to understand and communicate, incorporates the time value of money, and helps benchmark returns effectively. One limitation to consider is that the internal rate of return, or IRR, can produce multiple values when cash flows are irregular, which can make decision-making confusing. Also, IRR results may conflict with net present value, especially when choosing between mutually exclusive projects. Another assumption is that cash flows are reinvested at the IRR itself, which might not always be realistic. Moving on to the payback period, this method looks at how long it takes to recover the initial investment from accumulated cash inflows. The basic rule here is to accept the project if the payback period falls within the company's target timeframe. It's especially helpful for smaller investments or situations where liquidity and risk reduction are priorities since it focuses on how quickly the money can be recouped. For instance, retail companies often use payback analysis when deciding on store refurbishments because they want to recover their capital quickly. The payback period is straightforward and fast to calculate, highlights liquidity and risk, and can be a useful first step to screen projects. However, it doesn't account for the time value of money, ignores any cash flows after the payback period, and doesn't provide a measure of overall profitability. After this, we'll look at the discounted payback period, which builds on this concept. Discounted payback enhances the traditional payback method by taking into account the time value of money, meaning it discounts cash inflows before calculating how long it takes to recover the initial investment. The decision rule here is to accept a project if the discounted payback period falls within an acceptable limit. This method is particularly useful for companies that want to focus on liquidity while also recognizing that money today is worth more than the same amount in the future. Its advantages include factoring in the time value of money and maintaining focus on liquidity and risk, but it still ignores any cash flows that occur after the payback period and is more complex to calculate than the simple payback method. Moving on to the accounting rate of return, or ARR, this approach measures profitability based on accounting profits rather than cash flows, calculated by dividing the average annual profit by the average investment. The rule is to accept projects where ARR exceeds a predetermined target return. This method is commonly used by organizations that emphasize accounting metrics and care about how investments reflect in financial statements. Public sector organizations often use the accounting rate of return, or ARR, when they need to evaluate investments within strict budget limits and based on reported profitability. ARR is simple and easy to understand since it uses accounting data that's already available. However, it has some drawbacks. It doesn't consider the time value of money, focuses on accounting profits rather than actual cash flows, and can be affected by different accounting methods. Moving on to the Profitability Index, or PI, this method calculates the ratio of the present value of future cash inflows to the initial investment. If the PI is greater than 1, it's a signal to accept the project. This approach is especially useful when companies have limited capital and need to prioritize projects. Its key advantages include factoring in the time value of money and helping rank projects when funds are tight, but it also has its disadvantages, which we'll discuss next. Investment appraisal techniques are essential for making sound financial decisions because they help organizations evaluate profitability, risk, liquidity, and value creation from different angles. While no single method is perfect, they work best when used together. Net present value is often seen as the most reliable because it directly measures how much value a project will add for shareholders. Other methods like IRR, Payback, ARR, Discounted Payback, and Profitability Index offer useful insights that can address specific concerns or preferences. Many successful organizations use a multi-criteria approach, prioritizing NPV but also considering other techniques to manage risks, capital limits, and strategic goals. When these methods are applied carefully and aligned with a company's objectives, they ensure resources are used efficiently, risks are clear, and long-term value is maximized. The image here, showing people stepping up on stacks of coins, symbolizes how thoughtful investment decisions support growth and increasing shareholder value over time. It's important to remember though, some techniques like IRR may misrank mutually exclusive projects and can be less intuitive than NPV, which is why a blended approach works best.